Welcome to Fall into ETF Investing, a special edition of ETF Market Insights. I'm Erin Allen, Vice President of Online Distribution at BMO ETFs, and I'm about to turn it over to our guest host for today, Jessica Moorhouse. Before I do, a quick reminder that during today's episode, we're not providing any advice or investment recommendations. Today's show is all about education around using ETFs and around investing for the Canadian do-it-yourself investor. Jessica Moorhouse is the host of the More Money podcast, where she tackles personal finance and investing topics. She's also an accredited financial counselor and a personal finance expert. So now I'm going to turn it over to you, Jessica.
Hello, I'm joined today by Paul from MSCI. Paul is Executive Director and Head of Wealth Indexed Investments. MSCI is a leading provider of indexes and a leader in ESG research. I'm also joined by Rosa Van Den Beemt from BMO GAM. Rosa is Vice President of Stewardship Responsible Investment at BMO Global Asset Management. And Rosa is also a corporate engagement practitioner with 10 years experience in the responsible investment industry and joined BMO GAM's responsible investment team in early 2020. Rosa specializes in North American corporate governance and engaging management and board members on ESG. Now, during today's session, we're going to be discussing ESG investing and how it can help manage risk in your portfolio, along with how ESG ratings and indexes are constructed. We will also look at the other side of the responsible investment coin, active ownership and engagement, and learn more about how that is an important consideration. So let's start with you, Paul. Thanks so much for being here. Let's start the conversation with kind of an important question. What is ESG investing?
Yeah, well, let me start by thanking you for having me, Jessica, and our partners, obviously, at BMO GAM. So I'll give you the simple answer first and then maybe walk through some of the history of the industry. So simply put, ESG investing is the application of environmental, social, and governance lenses to an investment process, in addition to all of the financial metrics that people tend to care about. Now, what I do want to be careful about is to make sure that it's not a measure of corporate goodness, for lack of a better term, but more of a measure of corporate resiliency to environmental, social, and governance risks. And I think that's a common misperception. And if we think about the evolution of the industry and where we started, there's a couple of different subtypes of ESG investing. The first is socially responsible investing, or what some people would allude to today as values investing. And it's essentially the elimination of things that investors find objectionable. So years ago, it was tobacco, alcohol, firearms. Today, potentially more energy related, but that's really the generation one approach. A more modern approach is what's referred to as ESG integration, where it's less purely about the elimination of things and more about positive inclusion of highly rated companies, regardless of what industry they're in. The third subcategory would be what I would call either single pillar ESG investing. Some people call it impact investing, but it's nichier. It's got a very narrow focus. Some examples would be women's leadership is a very popular style of investing. Green buildings has gotten pretty popular. And then the fourth subcategory, what we at MSCI believe is really a standalone category, is climate investing. Due to the progress made at the Paris Accord 7 years ago and COP21 and all the frameworks that were created after that, this has become a distinct field of investing where investors seek to only own investments that are aligned with a 1.5 to 2 degree warming scenario.
Okay, now can you provide a general update or overview of the ESG ETF market in Canada?
So at the moment, the ESG ETF market is roughly $10 billion in AUM, spread across 130 products. And so for those listeners that are interested in learning more, BMO Wealth Management has some excellent research out there. They've written extensively on the ecosystem that's available. It represents about 3.5% of total ETF AUM, but it's growing rapidly. If we were having this conversation 3 years ago, it would have been about $2 billion in AUM and about 30 or 40 products. And I guess in my opinion, 2019 and 2020 were incredibly important years for the ecosystem. And that's mostly because large ETF sponsors launched full suites of ESG ETFs. And so it all of a sudden became possible that the listeners could build a fully globally diversified ESG portfolio inclusive of equity and fixed income, whereas that was not the case previously.
Now, what is the difference between an indexed-based ESG solution and an actively managed ESG solution?
So the major difference I would characterize is human judgment versus a transparent rules-based approach. And so let me elaborate on that a little more. An active portfolio manager often has all of the tools available to them that are used in the creation of an index. However, they have the discretion on what they want to overweight, what they want to underweight, perhaps even ignore. At the end of the day, every holding rests with them. An index certainly has some judgment going into the creation of the rules up front, but once those rules are decided on, it is fully automated. There's no deviation at all. And if you think about that, in my view, there are two major implications of those differences. The first is that an index gives you a more predictable ESG footprint and exposure over time because it's sticking to those rules. And so if you want to understand the ESG profile versus some of the indexes that people see on TV and generally track as a barometer of market performance, the consistency is there. Similarly, from a performance and risk perspective. The second major implication is cost. Generally speaking, index-based investing is about a third to half the cost of active management. And so there's a certain element of value there for investors for sure.
Absolutely. Now, how does ESG awareness impact the risk of a portfolio?
So that's a really good question. And I guess the way I would answer it is ESG awareness seeks to avoid bad outcomes. And if you translate that to a risk perspective, you would expect lower volatility over time. And let me maybe walk through a few examples. So I'm going to date myself for sure on this first one. But I'm old enough to remember the Exxon Valdez oil spill 30 years ago. And 11 million barrels of crude oil spilled off the coast of Alaska, an absolute environmental disaster. And images clearly plastered all over the news. Now, what most people don't realize about that incident is that Exxon's stock price only moved about 5%. And it pretty quickly recovered after they started making progress on the cleanup. Now, if you compare that to more modern day ESG disasters, there's a lot of research out there to indicate that companies are punished more quickly and more severely than they've ever been before. And so I guess there's a few high profile examples, right? Vale, the Brazilian mining company, had a dam collapse on them in 2019. Horrible outcome. Volkswagen and the emissions scandal, the Equifax privacy breach. In all of these incidents, the peak to trough stock move wasn't 5% like Exxon, but 25 to 30%.
Wow.
And it makes sense, right? If you think about the world we're living in with smartphones, social media, the ability for a company's worst moment to be plastered across the globe instantaneously, you can understand why the stocks would be punished. And so I guess to answer your question directly, when you think about ESG index construction, the normal Canada index has roughly 100 stocks in it, whether it's ours or a competitor's. The traditional Canada Exposure ESG Index has 50 stocks in it. And so if you can just avoid a handful of really bad outcomes when you cut it down from 100 to 50, the thought process is that you have lower risk in the end.
Now, how does MSCI derive an ESG rating? I think that's probably what most people want to know.
Yes. So the simple answer to that question is that it is a sub-industry centric relative rating. And I really want to emphasize the point relative, because oftentimes I get the question from investors, how could energy company XYZ possibly have a good ESG rating? They mine fossil fuels, they have high carbon emissions. Or I get the question, why doesn't Tesla have the best rating possible? And so, again, emphasizing that point relative and sub-industry centric, the whole point of an ESG rating isn't to penalize or reward a company based on the industry that they're in. It's to compare like companies to one another. And so if you're an ESG investor and your goal is climate-oriented or UN SDG alignment or eliminating companies in a particular industry, of course we have tools for you. But that's not the point of an ESG rating. So to dig a little bit deeper on exactly how we construct it, the first part of the process is sorting the 10,000 or so companies that we cover into their sub-industry. And so a sub-industry is part of the GICS standard. So if you hear a portfolio manager on television talking about the fact that BMO is a financial services company or Enbridge is an energy company, 9 times out of 10 they're referring to GICS. It's by far the most popular sector classification standard in the world. And so you have 11 sectors at the top of it, about 25 industry groups, 60 industries, and 160 sub-industries. And so once we group by sub-industry, we then go about identifying what the key issues are that drive the ESG profile of each sub-industry. And using, again, the BMO Enbridge example, financial services is a trust business. You would expect a really high score for corporate governance. Energy puts a lot of stress on the environment, and so you would expect the E to be higher. But regardless of what those weights are, we pull from a bank of 37 key issues. Governance is always a minimum of 33% weight. We look at things like board pay, independence, accounting practices, et cetera. And so once we've sorted by sub-industry, once we've identified the key issues for each sub-industry that we tweak once a year in consultation with our clients, we then go about doing the work of assigning ratings. And like most things in life, there are a couple of phenomenal above average companies. There are a handful of below average companies and a lot of clustering in the middle.
Now, how is the MSCI ESG Leaders Index constructed specifically?
So the ESG Leaders Index takes a few elements of our ESG research and ratings into its construction process. And maybe let me start by defining the choices that need to be made in an index. So I think everyone's familiar with the market cap index, right? It's simply some cutoff on the number of companies or the minimum liquidity weighted based on their size measured by market cap. The moment you deviate from that, what we at MSCI would call an investment thesis index, there are 4 major decisions that you need to make along the way. The first of those decisions is, what market do you want to cover? Are we talking about just Canadian large cap stocks, mid and large, small, mid and large, all of North America? You have to define the market. The second thing that we need to figure out is, how do you eliminate or narrow down that initial market? And in the case of ESG leaders, there are a few ways that we do that. The first is based on business involvement screens. There are 10 different business activities that are not eligible for inclusion in the index. Things like tobacco, alcohol, firearms, thermal coal, et cetera. The second source of elimination is what we call an MSCI controversy score, a 0 to 10 quantification of how much controversy a particular company is embroiled in. 0 is the worst, 0s, 1s, and 2s are eliminated. The third source of elimination is the minimum ESG rating, which for this particular index is a BB. It's a AAA to CCC scale. Once we've eliminated all of those securities from eligibility, step 3 is figuring out what the constraints of the investment thesis index are going to be. In this case, the major constraint is sector neutrality. So Canada has a very high proportion of financial services and energy companies in any index, So the Canada ESG Leaders Index is going to have the same exact weight in financial services and energy. And then the fourth decision that has to be made is the weighting scheme. Is it going to be market cap weighted, some other methodology? In our case, once we achieve that sector neutrality, we then start just by including all of the AAAs in that particular sector. AAs, single A's go down until we have 50% market cap coverage. So at the end of the day, you get an index that is well balanced, that has 10 different business involvement exclusions, that has sector weights that are equal to the parent index.
Amazing. Last question, and you kind of touched on this with that answer. What are the biggest benefits of the MSCI ESG Leaders approach?
So I think there's a few things. The first is that it's got a large ecosystem behind it. So not only are there BMO ETFs and other ETFs linked to these indexes, but large pensions, foundations, and endowments use them as their policy benchmark. There's a derivatives ecosystem. They have multiple users. They're a standard in the industry. I think speaking more personally, I just kind of like the trade-off that they give you, right? Based on that methodology we just discussed, there's always a back and forth between ESG purity and how much you are willing to deviate from a market cap index. And I think this particular approach strikes a nice balance. You have about half as many holdings as the parent index, and you have a tracking error somewhere in the range of 2 to 3% a year, which I think is reasonable.
Well, thank you so much, Paul, for that overview of ESG investing and, of course, the MSCI ESG Leaders Index. Now, you can invest in an ETF that tracks this index with BMO. They actually have 4 different ETFs: ESG-A, ESG-Y, ESG-E, and ESG-G. And they also have BMO's balanced ESG ETF, ZESG, which is a balanced asset allocation ETF that invests in a number of their ESG exposures. Now I want to turn over our discussion to Rosa so we can discuss the other side of the coin when it comes to responsible investing, and that's active ownership and engagement. So Rosa, let's start off with this question. Can you explain to us what active ownership and engagement is and what your team's approach is at GAM?
Yeah, of course. And thanks so much for having me, first of all. So there are a lot of different words that kind of mean the same thing. Active ownership, engagement, we call it also stewardship at BMO GAM. And it is essentially engaging with the companies in your portfolio, so the companies you own, to create positive change. So that can be addressing ESG risks and opportunities. It can be trying to move certain companies in a more positive direction, addressing types of controversies that they've had. And under the umbrella of stewardship, you can see company engagement is one element, and that's really direct dialogue with companies. So sitting down with the board of directors or executives to discuss an ESG topic. Proxy voting is another element of this, and that is really using your right to vote at a company's annual shareholder meeting. So this can be anything from saying yes or no to the directors who are on the slate, or things like executive compensation, or also sometimes environmental and social issues. So at BMO GAM, we have a strategy that is really based on 3 pillars. So the first pillar is ESG risk, engagement on ESG risk. And that's really taking like the type of ESG data that MSCI provides and looking across our holdings to see what companies are really lagging on ESG performance and engaging with them to make sure that they can enhance that performance over time. Because we all really want the company to do well, once we're invested in them. The second pillar is around our 2 key thematic areas, climate action and social equality. And those 2 thematic areas we've chosen really because they are not company specific, but they're really sector-wide, industry-wide, market-wide. Of course, as we know, climate change is one of the defining key issues of our time. And social equality, we think, is the second key issue of our time, really, and also necessary to be able to solve issues like climate change. And so the climate action and social equality pillar of our engagement program is focused on thematic projects. So it could be a project engaging companies entirely on getting to net zero, so net zero emissions by 2050. Or it could be under the social equality umbrella, engaging companies on human rights or labor issues or Indigenous reconciliation. And then the third pillar that we have is called governance foundations. And it's a little bit more boring, I would say, but it is really to make sure that companies have that type of governance foundation necessary to be able to perform as a good company. So transparency, accountability, making sure that there is responsibility at the top for ESG issues. And it really is closely related to our proxy voting. So there's a lot of engagements with companies before we issue our vote at the shareholder meeting, during that season, and then afterwards as well, to make sure that we follow up with the companies to make sure that they, do what they had set out to do.
Now, when an investor invests in a BMO ETF, what can they expect from an active ownership perspective?
That's a good question, and I think a lot of people might not know this, but really our engagement program covers all of BMO GAM's funds, so also the ETFs. So they can expect a full voting from us, active voting on all of the shares and the companies that are in those ETFs. They can expect engagement on ESG risks and opportunities, on climate action and social equality, as I explained earlier. But it also covers things like policy engagement, which is engagement with policymakers, governments, standard setters. And this is really about making sure that the bar is set higher, the standards are set higher for an entire market or country. So an example of that would be, we have been advocating in Canada for stronger modern slavery legislation, and that is actually asking for stronger rules for companies to disclose how they are ensuring that there are no modern slavery risks in their portfolio, or in their operations, and disclosing that as well. So letting investors and just the general public know that they have investigated, that they have measures in place to ensure that there are no human rights or modern slavery risks present in their operations. And so everybody who invests in an ESG ETF or an ETF or any other fund of BMO really benefits from that type of engagement that we do, both around the indices as well as the companies in the portfolios.
Now, can you provide some examples of how you've made an impact when it comes to a company's approach regarding specific ESG issues?
Yes, gladly. I have two examples. One of them is on climate action and is around Suncor. We probably all know this company quite well. They we've been engaging Suncor for, I would say, over a decade. But in the last few years, we've been engaging them as part of an investor collaboration that's called Climate Action 100+. And we are one of the investor leads for this company. Basically, when we started out this engagement, Suncor didn't really have firm commitments to reaching net zero by 2050 in place. And they did have climate strategies, but they weren't as well defined, at least not the way that we wanted them to be. So we worked with them for a number of years, and then we were happy to see them last year actually really come out with a new climate strategy. It included things like electrification, hydrogen, a plan for investment into lower carbon fuels. They also came out with a commitment to reach net zero by 2050. And they also set some absolute emissions targets for 2030. So a lot of change. They really turned the ship around in a way. And then we were also really happy that they had tied some of these climate goals into executive compensation, so that executives would be, rewarded or penalized for reaching those goals. So that is one example. And then the other one that I wanted to touch on is Loblaw. And it is around diversity, equity, and inclusion. A big topic, of course, these days, and very important. And I think we also really feel that having a lot of diversity at the top can help manage ESG risks and can also really help a company take advantage of new opportunities. So as part of a sort of an investor collaboration, we co-drafted an investor statement called the Canadian Investor Statement for Diversity and Inclusion. And it was signed by a whole number of investors in Canada, institutional investors. And so as part of our commitments that we made in that statement, we reached out to a lot of companies in the Canadian market to share our expectations with them that they would have adequate representation of Black and Brown and Indigenous people on the board, so underrepresented groups. So really going beyond gender representation on the board, because I think we've really moved the needle on that already in the last few years. And Loblaw was one of the companies that we had reached out to and engaged with. They were the first one to set an actual target for having visible minorities on the board by 2024. I think the target was around 25%, and they are already halfway there, so they're at 17% now. And so we'll be keeping engaging with them to make sure that they reach their target, but a really great example of setting leadership in that space.
Absolutely. And my last question for you is, how is active ownership evolving, and where do you see it in the future?
Yeah, I think it's a really interesting space. It has evolved so much in the last 10 years that I've been involved with it. It's gotten a lot more collaborative, I would say. So investors are now really banding together to address those big topics like climate change. So a investor initiative that I mentioned earlier, Climate Action 100+, is now in a way being duplicated to just focus on the Canadian market, and that's called Climate Engagement Canada. So it's all Canadian investors engaging with Canadian companies to get them to net zero, and I think that's really great. Some of the biggest investors are at the table, and companies are generally receptive, when there's a lot of force behind these initiatives. But I also think there's going to be a little bit more focus on the human rights equation of this. I think investors have rallied behind climate change really well, and now it's time to really look at human rights as a key critical issue. So the United Nations Principles for Responsible Investment, it's an investor network where most of the investors who are responsible investors are members. They have just launched a new initiative called Advance, and it's really focused on human rights. We're really pleased that we are going to be able to lead some of the big Canadian names in that for that engagement. So that would be us setting sort of the agenda and the focus for engaging on human rights with Canadian companies.
That's amazing. Well, thank you so much, Paul and Rosa, for those great insights. We appreciate you sharing your knowledge. And thanks to BMO ETFs for putting together this event on ETF Market Insights, giving DIY investors quality education around investing. And we hope you enjoyed this session, and thanks so much for watching.